I could not have summarized it better. Stubbornly high inflation, gloomy economic outlook, extreme market volatility, widening credit spreads. So I guess now that we're all cheered up, it's time to try to assess what this means for the global insurance sector. I'm not doing that alone. I have help of a wonderful panel. So at the left side of me, we have Gustavo Caldas, technical analyst in charge of international relations at SUSEP, Brazil. Welcome, Gustavo. We have Sean Ringstead, executive vice president and chief digital and chief risk officer at SHUP. Welcome, Sean. And online, I have with me as well Kate Hsu, chief risk officer from Great Eastern. Welcome, Kate. And Peter Geiger, chief risk officer from Zurich. Welcome, Peter. And thank you for joining us. This is going to be a hybrid panel. I'll do my utmost best to channel between the physically present panelists and those that have joined us virtually. Now, what I would also very much like to do is get the input from the audience. So this input we will use and try to wave into our discussions. And for that, we have our Slido tool. And I would like to bring up the first polling question, if that's possible. Let's wait a few seconds for the question to pop up. I don't think that's the first one. Yes, here we are. So let us pretend that we're all chief economists here. My question to you is very simple. What are your expectations for the global economic outlook? Are we having a recession in 2023, but can we expect a quick bounce back? Are we having a recession in 2023 and followed by a protected downturn? Are we having no global recession, but a recession maybe in several large economies in 2023, followed by a quick bounce back, and then again the same scenario, but with a protected downturn? Or nothing at all? Are we worrying a lot? And we shouldn't be worrying a lot. There will be no recession in 2023. So please give me your insights, and I'll try to get back to the results a little bit later and try to wave that into our discussions. Now, my first question is, we've heard from Suzette what is the global economic and financial stability outlook, and my key question to, in particular, the insurers who are in our panelists, so Peter, Sean, Kate, feel free to pop in. What do you believe are the key risks for insurers at this point in time? What should we maybe be most worried about? Feel free to anyone who would like to jump in. Peter, yes, please.
Well, I think a macroeconomic environment as we currently see it is what we risk officers live for. I mean, it's full of entertainment. So why would we want it to change? But joking aside, it's the prolonged level of uncertainty that is putting us to a test. And I think we should not expect that to change anytime soon. The world was always an uncertain place, will always be. And so whilst we have a history of crisis, we should not assume that this will stop anytime soon. I hear a lot about the macroeconomic challenges, namely inflation, though I don't think inflation is a risk per se. It's the lack of preparedness or experience in certain jurisdictions that is posing a risk. But there is no strong correlation between insurance profitability and inflation as such. I mean, as a global insurer, we have markets where inflation is a constant, and our people there are perfectly prepared to deal with it. And I think in your audience, you have a lot of people who are used to inflation. It's more a Western issue that most of us have never lived in an inflationary environment.
Yeah, thanks, Peter. And we'll come back to the inflation topic, but it's very useful that you've already set a bit the scene here. Anyone else, Kate or Sean, want to pop in?
Dieter, would you like Kate to pop in? I'm happy to jump in.
Yeah, please.
Happy to jump in. I agree with some of Peter's comments, and we can come back to inflation. But yeah, it's incredibly volatile period. And I think, to Suzette's comment, you sort of prepare for the worst, and if we get pleasantly surprised, then that's a good thing. So, as you know, on the risk management side, we're always preparing for the worst, and you want to be flexible. You want to be vigilant in this environment. But the intersection of risks that we see today, whether it's macroeconomic, whether it's climate change, whether you want to put in cyber as a systemic operational risk. I mean, the period that we're living in, the interconnectivity of how we live, how we work, how businesses run. We're so interconnected, and you have these data points where you can get a glimpse of systemic risk in that way, whether it's the economy, whether it's cyber, and so on. So I think that's something that's very much top of mind as we look at our risk management.
Yeah, very true. I mean, we experience every day how globally interconnected the economy is, and how one small problem in a particular part of the world could really create that wave of issues that we've seen. It's good also to hear that as chief risk officers, you do very much the same as what we try to do as supervisors, try to assess what this could mean indeed for the global insurance sector. So, I mean, we've mentioned a few times already, Suzette highlighted it as well, one of the characteristics of the macroeconomic environment is the high inflation. And maybe before I turn back to the insurers on the audience, I would maybe like to go to Gustavo and ask you, Gustavo, because we've heard it. Some economies are more used to high inflation than others. And the discussion that we're now having on high inflation is often a discussion which is very much focused on what is recently happening in advanced economies and advanced markets. So, are there any lessons learned maybe from our side that you could then help us with in terms of your experience as an emerging and developing economy with inflation?
Well, thank you, Dieter. High inflation is actually affecting almost every country, because all of them that at least had these minimum wage programs afforded by the government have this problem of public expenditure that is causing the high inflation. And to the insurance market, the effects may be on higher claims costs, but that may be somehow compensated by higher returns on their investments because of the higher interest rates also. But in respect to high inflation environments, yes, in effect, as you may well know, we've had a long period of high inflation in Brazil. And in general, to deal with the high inflation in a traditional way is increasing the interest rates in order to slow down the economy and reduce public expenditure also. And for the supervisory side, we have to increase our monitoring of the effect on the reserves of the companies, to check whether, especially for accumulation products, what can be happening to those reserves that are long-term in nature. And they can be impacted by any degree of indexation that may have, especially to minimum wages. From our experience, a persistent and long-term environment of high inflation, the general tool that we applied back then was all the economy was indexed. We had inflation indexes that pretty much drove readjustments in prices and salaries. And although this may work quite well for investments and assets, it produced a vicious circle where salaries and prices were readjusted in a way that was always increasing, and salaries chasing prices. So for those who received those salaries, it was always less disadvantaged position, and it's hard to leave this cycle, right? In Brazil especially, we had to have an economic plan that changed the mindset of people about the inflation in this habit of every month to readjust prices. The top dog in the room was the financial officer, because companies made money by managing cash flows instead of their operation itself. So it was a hard time, especially for planning, because you had all those uncertainties that were mentioned by Peter were there all the time. You didn't know where prices would be next month, where costs would be next month, and so it was especially difficult. In general, for managing this risk, the question is that we had, obviously, investment tools, instruments that were also indexed. And companies had that. You may know that the Brazilian banking system is one of the most advanced in the world. We're first in a lot of aspects of digitalization and automation because of this need of this fine-tuning of their financial management of cash flows. And we had those investment instruments that were indexed also. And companies learn how to manage to quickly change from one instrument to the other according to their needs in relation to pre-fixed investments, assets, or post-fixed investment instruments according to their needs. But this was what we called a financial carousel, because it was overnight, and it was a very, very stressful environment. So the recommendation is that do not get used to high inflation. That is very bad.
Thank you for sharing that experience, Gustavo. Very interesting. And I mean, this is also something we do start to worry about more generally now. This vicious circle, as you say, between price increases, salary increases, and etc. And the big question mark: how long we will have to sustain this. Now, to go back to the insurers on our panel. Peter, you've already highlighted it a first time. It's part of being prepared as an insurer for high inflation. Where do you see the impact of inflation? If you could explain that to the audience, is it something you see on both sides of the balance sheet? Is it something we should be worried about more in terms of life insurance or non-life insurers? May there be an impact, for instance, also on business volumes? What's your key take on this?
Well, first of all, it really varies by line of business or product. I mean, we see in property and casualty insurance, every line has its own signature when it comes to inflation, and most of them are actually only loosely tied to the CPI. So most insurance companies will not have projected the zero level inflation that we have had historically in their reserves, but taken more average assumptions. And by the way, for example, medical inflation in most countries was never zero. So if a line is driven by medical inflation, you always had over the recent years inflation assumptions in it. In a perfect world, your premium will reflect the increases, your reserves will project the inflation, and investment income provides for the discounting. So everything will be fine and stable. Now we all know we're only not in a perfect world. So every step of the equation is error prone. But I think it's the business of an insurance company. I mean, all our claims estimates are exactly that. Their estimates, and inflation is just one of the uncertainties that we're confronted with. On the life insurance, I think it's more an affordability issue at the end, because many of these products are savings driven in nature, and if consumers become constrained by affordability, then this savings is one of the things that will kind of come into focus. But more than anything else. On the other hand, increasing interest rates, I think, and I'm saying increasing interest rates because they're still very low in historical terms in many jurisdictions, but increasing interest rates gives some relief in terms of achieving positive nominal returns, which is psychologically a very important ingredient for many life products.
Yeah, thank you very much, Peter. Sean, any input also from your side on this? How do we see the impact of inflation for insurers?
Well, my comments would be on the non-life side. We're primarily a non-life insurer, and it's an incredibly important topic. And you know, as I said, you have to be vigilant and you have to be prepared. I think it's important, and it's not that we've been in a low inflation environment. As Peter said, we've always had inflation, and it's not necessarily that we've been in some countries have been able to deal with high inflation. I think you have to unpack and look at the underlying drivers of inflation. I mean, the CPI, the inflation metrics that Suzette put up are very helpful, but you have to look at it by the line of business, and you know, just simple examples, right? If you, I drive a scooter to work, so it's pretty simple. But if you're lucky enough to drive some of the more modern, like a Tesla type car, when you look at the technology that's sitting in that car, the cost to repair that is much higher than it was before. So your data, you're always lagging your data in this business. So it's incredibly important to understand those trends. And not only is it the cost of replacing, if you happen to damage the car, you may not even be able to get the parts. And that just drives up the cost, right? If you have a property that's damaged, the cost and availability of components to repair it. So I think you have to look at it by line of business. And if you get into the casualty world, liability world, a trend that we're seeing on top of economic inflation that I think is a systemic issue is the worsening legal environment. And we see this in the US, we see this in Europe, we see this in Australia. The legal environment is worsening, and you can think about the impact of that in two components. We spend a lot of time looking at this issue. It's important for us on the liability side. You think about it in two components. One is litigation as a business, and this is where lawyers are driving up costs with excessive or abusive claims, and there's litigation that should provide fair redress for claims, but in that context, in that business, it is not. It's abusive, and it's driving up costs, and think about that as a cost not only to business but also to society. So we think of that as a very real component with inflation, and we also think about social inflation and this notion that if something bad happens to me, it's somebody else's fault, and you know, within reason, but you know that it's going beyond the bounds, and you can think about the impact of that as reinterpreting coverage language to jury awards. So I would layer in that component as well of inflation, and so what does that mean? I mentioned we're reliant upon past data. It's a lagging business, and so it's back to the fundamentals. You have to be really vigilant on the reserving and the loss trends that you're using, and you have to be very vigilant on the pricing and making sure that it's catching up. And we also spend a lot of time. We're very focused on the feedback loop between claims, between actuarial and underwriting to make sure. Because you have to be on the front end of what's emerging, you know, whether it's in auto insurance, cars, whether it's on the property side or on the liability side, you have to be so focused on this, whether it's frequency, severity. You can't be doing this annually. You have to be right in there understanding what the drivers are. So I think it's a very very important topic for non-life. It's what we do, but we're in a period now where it's really important to be vigilant.
Thank you. I guess it's a very interesting link there that you established between inflation environment, the legal environment, and also the importance of coverage language. Yeah, indeed, that makes a lot of sense, and I think that again stresses also what Peter said before on how important it is to prepare yourself and think about these things. Now, Kate, allow me to turn to you. I hope that I heard that you had some connection issues. I hope that those have been re-established in the meantime. Any input from your side?
Yeah, sure. I'm not sure if the connectivity is going to drop off, but hopefully after I speak. So for me, I think there will be impact differences for live versus like non-live business, and also in different time horizons. And actually in insurers in Southeast Asia are actually seeing some of these effects already from elevated inflation levels. I would say recent impacts are on more on medical and motor insurance, and it's definitely coming through claim and inflation experience. So I think repricing will eventually have to kick in, is what the general feel is, as if claim inflation is to continue to be elevated. I think also with a prolonged recession, it can lead to heightened general insurance risks, such as those that we do write, like credit insurance, unemployment, and it could also have higher costs of like arsons and suicidal risk claims and whatnot. In terms of, I would say, business mix, insurers have been changing product mix, actually, especially for lifers. Lifers that write endowment with guarantee rates, which is actually a very popular saving products here in Asia, or even whole of life, such as universal life products and so forth. Yield curve have actually gone from upward sloping to acutely actually inverted this year, with a yield differential of up to like 50 basis points from like the short to versus essentially the long end of the curve. This is kind of the experience here in Southeast Asia. So this has actually made long-term endowments virtually almost impossible to be written. Saving funds are actually flowing into bank, like short-term deposits, or even like T-bills, which are yielding higher than like long endowment products that can be offered by life insurers. Even the 6 months like T-bills that's currently offered is higher than what we can offer as a lifer for a 10, 20-year endowment. So insurers are actually also beginning to observe a higher trend of surrenders, especially for products that are leveraged and those written without surrender penalties or are out of penalties periods, especially when funding rate essentially exceed what insurers' crediting rates are. I think for lifers, there is a need to really pivot towards more protection business. As for impact on the asset side of the balance sheet, non-life assets tend to be actually invested in quite short in fixed income assets, where there is some negative mark-to-market duration impact, actually due to no offset from reserve, as most non-life liabilities are not interest sensitive, right? For life, it's actually an interesting one. Most lifers have very long dated liability duration, and due to shortage of long duration assets, especially for the Asia region, insurers have been running actually a large duration gap on their back book. With rising rates, mark-to-market on the assets are negative and are impacting investment returns for sure. However, on the balance sheet, mark-to-model on the liabilities are much larger due to higher rate of discounting, which actually result in an increase in capital and actually strengthen solvency position for quite a number of like lifers here. Therefore, on the life side, it is actually not all that bad, I would say. Over the long run, higher interest rate is actually good for the life insurance industry. There's also an opportunity actually to lock in higher rates and manage down ALM gap risk, which Asian insurers have been grappling with in the past decades.
Thank you very much, Kate, and thank you for bringing this perspective also for the life insurance market. I think, as Peter highlighted as well, it's not all bad. So if to the extent that the high inflation also shifts the yield curve, there are some benefits also for in particular life insurance challenges as well, as you said, in terms of certain saving products, long-term endowments you referred to, and maybe we'll have to watch out also on what is happening on the surrender side for policyholders indeed. Yeah, okay, thank you very much. I think also here it's time to take another look at the results of what the audience was thinking in terms of our near future. I would be very interested to know what the results of our polling. Oh, it seems quite well distributed. I guess most of us are on the pessimistic side, expecting a global recession next year, followed by a protracted downturn and like across all economies. For some of us, it's more something that will be focusing on several large economies. There's only 5% of the audience that seems to be living on the optimistic side, not expecting any recession in 2023. Well, good to know. I think that gives us also a little bit of background and gives me also reason to maybe bring you to the next polling question, which is actually on inflation. So we've been discussing inflation on our panel, so it's time to get also some input from the audience here. Where do you see the main impact from inflation, in particular on non-life insurance? You see it in terms of increased claims inflation, which will also eventually eat into the underwriting profitability of insurers. You see the impact mainly on the premium side, which then eventually would even lead to a positive business growth. Do you see mainly a cost of living issue, which may reduce insurance coverage and reduce potentially future business if it turns out that policyholders just don't have the money to spend on buying insurance? I think that was also mentioned as a potential negative impact for life insurance business by our panelists. Or do you, after everything taking into account, only see a minimal impact of high inflation? There's also another category. I don't know exactly what we should understand with that one, but let's see. Feel free to give us your answers, and let's see within a few minutes where the audience sees the main impact of inflation. Now, for our panelists, I would like to get to the next topic. One of the things which were mentioned as well by Suzette were the widening credit spreads. We've also recently seen some challenges in terms of liquidity risks, in particular in terms of liquidity strains that were caused by certain derivative positions, and we may remember what's happened to the UK pension fund sector a while ago. So let's take a look at credit risk and liquidity risk. First question maybe to the insurers again in our audience. If we look at the liquidity risks that we have seen emerge in some markets, as I referred to the example of the pension fund market in the UK, is there anything to learn from what has happened here in terms of liquidity risk management from an insurance perspective? Should we be worried? Should we not be worried that something similar could happen to insurers? I would very much appreciate your input on this question. And I see Peter has unmuted himself already, so please go ahead.
Well, I think the lesson to be learned is old and trivial. If you get returned, you take risk. I think that's, for me, the simple equation of the UK problem. Even if some models convince you that you have a free ride, you never do. And that was a classic example when the risks that actually were rewarded by the market came home to haunt them and found them unprepared. In insurance, I think, look, my advice to supervisors is keep away from your banking colleagues. Because security transformation is a core banking business, and it's called duration mismatch on an insurance balance sheet, and it attracts capital in all the economic capital regimes. So it is in scope that type of risk. And also there is typically no acceleration of liquidity outflows on an insurance balance sheet. So reputation and the like cannot trigger a run on the insurance. And then once you've crossed that bridge, I think liquidity risk in insurance becomes a much smaller beast than it is in many other parts of the economy.
Yeah, thank you very much, Peter. And we'll take up the lesson learned very much to keep away from our banking colleagues. Thank you. Any other input? Kate or Sean, feel free to jump in.
I'll jump in. A simple P&C non-life person, and I think for me the lesson, additional lesson, right, is thinking about procyclicality and frameworks and measures that encourage procyclicality. And when things go wrong, they get worse. Was my simple observation on what happened in the UK. And so accounting frameworks or regulatory frameworks that allow leverage, allow procyclicality, sort of mechanisms that have to be, I think, well understood and tested. We saw it in the financial crisis firsthand in 08, 09, where you have leverage, you have hedging, you have liquidity, all these issues come together. And accounting frameworks can, I'm not saying they do, they can compound that right at the very time when you need to be able to step back and have relief. And so I think it's important to understand the implications. I think it's important to understand the implications to the business model. Certainly for us, our investments are there to back our liabilities. Our primary risk-taking activity is on the liability side. So simplicity is your friend. We don't have a run on the bank risk, and so I think coming back to the frameworks that are in place need to acknowledge and factor that in.
Yeah, thank you very much. There's indeed this important nuance between banking and insurance business, and as you said, also important lessons for us as regulators to think about how regulatory frameworks interact with liquidity risk and leverage. Exactly. Kate, feel free to jump in as well.
Sure. I'll share from an Asia region perspective. So liquidity, I think, risk still remains quite manageable, at least so far. As for non-life insurers, I suppose the assets tend to be in cash or very liquid short-term assets. Liquidity are more actually driven by catastrophic related events like risk. In Southeast Asia, it's quite common to essentially have big floods, earthquake risk, and so forth. But thus far, not causing any liquidity issues, as assets are largely in very near-term cash. For lifers, there are slight increase in surrender rates that we're observing. Most of the investment are also in fairly liquid tradable assets with very minimum use of derivatives, I would say, for most countries. Most derivatives are actually to really just manage FX risk or in cross-currency swaps and so forth. Like ALM and investment strategies are still not as sophisticated, I would say, to closely adopt a liability-driven investment. So we do not have significant, basically, collateral issues or margining requirements from use of derivatives, be it essentially traded or OTC. Derivatives tend to be more used in the recent years, I would say, but largely for more efficient portfolio management and tactical asset allocation purposes, and also for de-risking, I would say, not widely used, more so in Singapore, but I think in the more emerging markets, even less so. So most insurers actually now adopted a risk-off position and are very underweight, we would say, risk assets at the moment, and very overweight cash, and in very short duration fixed income assets. So in anticipation of actually further drawdown, and therefore, I would say in healthy liquidity position.
No, thank you very much, Kate, for highlighting the importance of this cash and liquidity management as well. Maybe time to check the polling question before I turn into one question concerning credit risk. I would like to know where we are at here. Okay, so that's quite clear. I think we have almost half of the audience highlighting how high inflation really triggers a cost of living pressure, which could reduce insurance coverage and reduce future business volume. So that's really an interesting perspective in terms of way forward to think about. And as a second element, I also see that what we've discussed already, it's how increased claim inflation could also indeed eat into the underwriting profitability. I think it's fair to say that those are the two main answers from the audience. 2% of you have highlighted other. I'll try to talk to you during the break to see what you were targeting here. I would be very interested in that. Thank you. Another and last question for you as an audience, and since we're talking about liquidity risk and we'll be moving on to credit risk very soon, which risks from this list below do you think warrant most attention in the near future? Is it indeed the increasing liquidity risk, which we see being triggered by the volatile markets and potential derivative positions? Do you rather fear, and I think some of the panelists have already highlighted that, how liquidity risk could be triggered following higher surrenders in life insurance and also linked with rapidly increasing interest rates? Is it rather than liquidity risk, maybe credit risk that should warrant most of our attention? Credit risk then following the global recession and the fact that the recession will have a negative impact on both SMEs and large corporations? Or is it market risk following volatile equity markets? It's fair to say that what we experiencing lately on the equity markets is an environment where it's very hard to predict which way equity markets will evolve from one day to the other. So again, I would very much welcome your input, and we'll come back to the results in a few minutes. Now, before I turn to credit risk, Gustavo, I'm curious to know, what can we do as supervisors in terms of liquidity risk? What's our role here?
Well, Dieter, I'm not in a position to tell supervisors what to do, but I can talk about what SUSEP and our peers here in Latin America, at ASAL, I've been consulting with them, and yeah, we have not seen any real signs of material liquidity risk here in the region, but obviously we should and are monitoring it more closely. There may have been some minor changes in portfolio profile, but nothing really significant that should warrant some special action in supervision. In Brazil specifically, we have recently changed our conceptual framework for the investment of the supervised companies to a more principle-based approach. Before it was a more prescriptive, very prescriptive and restrictive regulation. So now we have this principle-based approach that applies also to liquidity matters, and it says that companies shall have in place an investment policy, written investment policy approved by the board, that is adequate to their liability and a good asset liability management, and observe principles of safety, profitability, solvency, liquidity, diversification, and adequacy to their obligations with transparency. We in Brazil specifically, we have a remain of the high inflation times where companies usually invest only or mostly in government bonds, because we have had for quite a long time high interest rates in Brazil, so it was comfortable for them to just adding to that prescriptive and restrictive investment rules that we had. It was comfortable to just invest mostly in government bonds, that liquidity is not a real risk for us in Brazil. Now that we are having this more flexible framework for investing, we should obviously increase our level of monitoring, but we do have a lot of tools, including we can block investments that companies do to back the reserves, and they can negotiate and trade them only if SUSEP allows it and other measures that we have in place. So I think we are now considering the Brazilian environment in a good position to monitor and to deal with liquidity risks. But in general, for the world, I think, well, a good risk management process always starts in identifying and measuring the risks. So monitoring the way things will go from now on and during the next year, and how this scenario that we were guessing in the pool will develop is a first necessary step that we all have to do.
Yeah, thank you, Gustavo. I think you highlighted well the importance of monitoring, also something we know it's not always easy to monitor liquidity risk. We have been working ourselves at the IAIS for 2 years to find a right and comprehensive set of liquidity metrics, and let's hope that once they are published now, that we can go ahead with those as a first basis to help us get a grasp of an idea, to get an idea about liquidity risk in the insurance sector. By the way, do we have some polling results before I turn to the last credit risk question for our insurance panelists? Let me check. Here we are. Interesting, and that's like the answer that I would have wished for, because that's the perfect link to to the credit risk question. So it's very interesting to see that more than half of the audience does see that it is indeed increasing credit risk following a potential global recession that warrants our attention more than the liquidity risk, no matter which of the liquidity risk perspective you take, and also more than the volatility on equity markets. So thanks the audience very much for that input, and that brings me to the next question. I think Suzette mentioned it as well. So increasing credit spread, global recession, fear of at least more credit defaults. So is that something insurers should be worried about, and what could you do about it? Any panelists who want to jump in on zooming in on the credit risk perspective here? Kate, I see you've unmuted.
Yeah, I'll go. So I'll say in terms of credit, I suppose the concern is more on default risk, and to some extent, I guess, spread risk, which affects, I suppose, mark to market. But sizable portion of these bonds, I think, held by insurers, held to maturity as matching assets for liabilities, especially for lifers. So in terms of strategy, so the concern is not so much on the mark to market, but rather essentially the default risk for sure. So in terms of strategy, it is actually to move up the credit curve and to avoid high yield space and even the BBB segment, I would say. In fact, as the equity market draws down, and bond yield improves, it is actually a good opportunity to allocate and lock in higher yields. But segments of credits obviously to avoid or underweight where credit risk can be more elevated. For example, I suppose in Asia credits, especially if there are continued stress in essentially the Chinese real estate sectors, and then also appreciating dollar, definitely something to watch out. But key is, I think, it's just to move to investment grade, high quality, and if you are holding to essentially match your liabilities, and it's not so much of a concern. It's just default risk that you kind of have to watch out.
No, I think could not have summarized that better, Kate. Thank you very much. Importance of watching the credit quality of your portfolio, indeed. Anyone else? Peter?
At the end, it's risk taking, so it's about risk reward.
Yeah.
And the question is, are we appropriately compensated for a risk that we see increasing? And I mean, increasing credit spreads seem to indicate that the compensation reflects the recession that is coming. So, but that's how we actually look at it. So if you have zero risk margin, you can take zero risk, which was a bit the case in some of the credit markets for a while. So I think we get to a more healthy stage where you're compensated for risk, but obviously there is risk in it. Otherwise, there would be no compensation.
No, for sure. Yeah. Thank Peter. I think I'm looking at the timing. I think we have time for the last question before I also open up to the audience. Let's take a look at what we can learn from the side of the IAIS here. So we have our holistic framework, which is in the last phases of a very important first 3-year review cycle. We know what the current market conditions are. So my question to you, and I turn first to insurers, but maybe Gustavo, feel free to jump in as well. What can we learn on the side from the IAIS here in terms of monitoring? We know we've set up the global monitoring exercise. We know that contains a certain amount of data collections, a certain amount of burden, both for yourselves as well as for us as supervisors. And what could we maybe learn in terms of macroprudential policy measures? Is there anything we should think about, consider, or also not consider? Feel free to jump in. Sean, if you like to give us your perspective, maybe.
It's a big ask. So my comments are humble. You're all experienced practitioners, I guess, from my personal perspective, and it's been more than can't remember, but it's probably 25 years of trying to manage risk and the preparing for the unexpected, and particularly going into a period of this type of volatility. To me, when we look at our risk management, it's very much back to fundamentals and simplicity and transparency. And I think the context of monitoring should look at the business model and have an understanding of the business model. So when I look at non-life, and we've hit on a couple of themes in this discussion already, it's not exposed to run to the bank. It is holding assets to maturity, and it's really thinking about where and how you want to stress test on the liability side, whether that's inflation or whether that's catastrophe risk. So I think when you're monitoring and when you're thinking about data, I think the context matters, and being able to look through and understand business models and individual insurer balance sheets, and sometimes data captures what you know. It doesn't capture what you don't know. It captures what you write, and just as important, I think, in times of volatility, it's what you don't write as well is just as important. Our basic business is property and casualty, and we stick to that. And I think knowing that gets you a long way in terms of thinking about monitoring frameworks. I think about integrated stress testing frameworks as being incredibly important. If we're stress testing for, say, natural catastrophe exposure or shock, we think about it from a reverse stress testing, and it's not a single return period that you're applying. It's what is the point of stress on your balance sheet, and not only that, it's the liquidity. So while we're not exposed to run to the bank, we integrate into our stress testing our ability to pay claims, and that's not just at the group level, but what's clearly important is fungibility at the legal entity level. So to sum it up, sort of simple approach maybe, but I think in these complex times, just having transparency, stick to the basics, and be thoughtful in that, and then that should hopefully guide us through this sort of volatile period. So I don't know if that helps.
It helps definitely. I mean, transparency, simplicity, it's not making it too complex. I reckon it's sometimes also a challenge for us as supervisors not to make things overly complex. And I very much like your idea as well also of reverse stress testing. It's also something I discuss regularly with our insurance undertakings in Belgium. It really helps you trigger to think about those circumstances where you could run into trouble and to make sure that you get yourself prepared for those type of circumstances indeed. Peter, Kate, anything from your side?
I think the only thing I'd really add to this is the discussion on risk tolerance. I often miss that because in an insurance company, everything starts with setting your tolerances, and I think the same should be true at the regulatory level. What's the desired outcome? And I'm sometimes getting the impression kind of societies today live in the illusion that we can have a risk-free life and it's not coming at the cost. And at that very starting point, I'm often missing in these discussions. What is it really that we tolerate and what are we prepared to pay for it? Because it will come at the cost. And I think that would give us a more sensible opportunity to trade off the various risks. Yes, the world is full of risks, but we can back solve how we sink our ships. But maybe the storm that it takes to sink our ships is so bad that we decide the world will be another place after the storm, and all bets are off. And I'll take as an example kind of what we do with government default. I mean, it doesn't make sense for us to hold capital against our own government. It's not something we should strive to survive. Although it can happen. I mean, we're 150 years old. Our currency is about that age, so you never know.
No, thanks, Peter. Gustavo, maybe from a supervisory side?
Okay. Well, first from a practical approach in the Brazilian side, we still have not yet used or take advantage of the GME as much as we would like, because we have an issue of being short-handed in Brazil and don't have enough hands to do the job and just to develop the framework and the procedures for our macroprudential supervisory process. And that has to do with the fact that we do not have IAGs, because our big companies do not have operations abroad, or if they have any, they are negligible. So we kind of watch and learn in order to put together our process in the future, which has been lowered in priority every year. It's being postponed because we just don't have the means to do it. But talking from a broader approach and including our ASAL peers' perspective, the amount and the granularity of the data that is required in the GME and the information that the GME provides itself gives us a good perspective of what the current issues are in the global scenario, and that helps us, giving us an indication of how to deal with these issues as far as best practices go, and serve as a reference, therefore, for this future work that we will have. And also giving us the opportunity to at least have in mind, and don't ignore, again, talking about the risk management process. If we ignore the risks, it's the worst way to do it. So we have that in mind, we know about it, we deal with it, and we are, not saying monitoring, but we accompany the discussion. I've been in the meetings, and I take to our colleagues at SUSEP the information that we are discussing, the way things are going, for us in order to, in the future, use that to develop our internal process. Or in other words, although we are not able at the moment to fully integrate the relevant aspects of the GME into our supervisory framework, we are creating an internal culture and knowledge, although not expertise, as to what is necessary to put together a good macroprudential supervisory process in the future. So this is our position at the moment, and hopefully in the future we can have a more participate more in the process with the IAIS rather than just observing and giving an outsider perspective that I've been doing.
No, but it's a fair input, Gustavo. I think it also worked from our side to make sure that the global monitoring exercise gets inclusive enough and takes on board all jurisdictions, which we know we're gradually extending it, and we need to make sure indeed that in that process we get everybody on board. And for those supervisors that have not yet set up like a macroprudential supervision within their authority, I think it's important that we make sure that they can also learn from the global monitoring exercise, for instance, and see how it can be used at local level. Kate, I give you the honor of maybe putting in some last thoughts here on this question before I open up for the audience.
Sure. I see it as, I guess, as the world returns to a deglobalization era, different regions may actually face divergence in risk. Take, for example, while most global central banks are deploying quantitative tightening, actually China actually may be continuing its actually quantitative easing. So different countries may also be at different phases, I guess, when we talk about essentially COVID policies adoption. So such divergence of macroeconomics and also public policies actually could also mean different risks for insurers operating in different markets. So I think deeper understanding of the markets and business risk factors has also to be considered, and to recognize, I guess, these differences when they exist, as well as an understanding of the interconnectedness of these markets.
No, thank you. That's very fair and a very, how I would say, interesting perspective, because a global monitoring exercise really is faced with the challenge to make sure that you, on the one hand, try to take into account differences in the world, and I think you've illustrated that very well on the one hand, whilst trying to find solutions to aggregate certain elements on a global level. So that's really the challenge that you've hit there. Thanks. I would like, I see we have some 9 minutes left, so if you don't mind, I would like to open up for some questions for the audience to see, maybe we can take 1 or 2 questions, hopefully. I see some hands up. You could just tell us who you are and what you would like us to answer.
Good morning, Robert Neal. I'm currently with the American Property Casualty Association. I've met many of you in my previous role at the American Council of Life Insurers, and as a former IAIS member at the Treasury Department under the Obama administration. But with that said, I would just ask, and kudos on an excellent panel, a lot of information. Dieter, I know yesterday at the EXCO dialogue, you mentioned the ongoing work of the IAIS in the cyber area, and that's something that the APCIA will be chairing the cyber working group at the Global Federation of Insurance Associations, so we look forward to working with you there. You referenced the ongoing work on the GMAR report, and I believe a report coming out in January of next year, so I just was going to ask if there's any additional detail you could provide as we continue to monitor that as well as part of systemic risk. Thanks.
Yeah, it's not much detail that I can provide you with. I think it will be more or less March than January, but I think cyber for us is a very important topic. It's also been highlighted as one of those topics that has potential for systemic risk. What we try to do in our GMAR special topic is very much focus on the underwriting perspective, because we feel that's where the IAIS can create the largest added value. So we know for cyber there is also the resilience perspective, being sure that you protect yourself as an insurance company from potential cyber attacks. But what we try to take here is to have a broad view of what is happening in the cyber underwriting market. Is it growing? Is it not growing? Do we see any protection gaps maybe? Are insurers able to deal with cyber coverages in a comprehensive manner? I know from my own discussions in my jurisdiction that silent cyber coverage, for instance, were not always well recognized, so that is quite a challenge to go through through the coverages of the different contracts and to try to understand is there maybe some cyber coverage hiding here that I'm not aware of? So that's quite a challenge that you want insurers to take up, I believe. Well, more to be followed. I hope that we can get ready for our publication of the special GMR in March, and I think in the meanwhile, and definitely also afterwards, cyber risk is definitely a topic in which we would like to continue engagement with all the stakeholders.
Thanks a lot, Volker Kutscher, Standard & Poor's Global Ratings. It has been good to hear that insurers seem to be on top of things with regards to liquidity risk, with regards to inflation. Also good to hear that it's coming from 3 very highly rated clients by us, so a different message and would be a bit puzzling for us. And looking into normal business years, like not the very volatile year that we have now, but also last year, we had natural catastrophe claims of 270 billion economic loss, and 111 billion has been paid by insurance. And insurance seems to be stabilizing economy worldwide. Here or there, it's local, it's global, what have you, and none of those insurers struggled. There has been no balance sheet events, there has been no failures whatsoever. So it seemed to be very stable. Not even asset sales didn't impact any market. So what I'm looking for is where's the risk for the economy coming from insurance, or what is the systemic risk insurers bring other than the banking products we heard earlier? And by the way, I'm happy to discuss the other risk with you in the lunch break.
Good. No, I mean, this is the question, right? If we would be able to solve it right away, then it would be easy. I think, I mean, we've been discussing this for a while. The nature of the insurance business is such that if you try to match your long-term liabilities with your long-term assets, you are a stabilizing factor on financial markets, or you could be. That doesn't mean, and that I think that's a fair warning which was given yesterday, that we should be complacent. There may be circumstances under which insurers at least may contributing to some systemic risk in certain markets, and that's something we should be wary about. So that means that investment behavior of insurers is very important, trying to understand that. We have seen in the last episode, for instance, it was not insurers, it was pension funds. That's been stressed already several times. How certain derivative positions can lead to certain market transactions that contribute to extra stress on certain financial markets. So that's something you need to be wary about, which again stresses the importance of liquidity risk management, and I think it was Kate who highlighted the importance of cash management also for insurers to be prepared in case of. Those are many different elements. You mentioned natural catastrophes. I think generally it's something which could create an important impact on insurers' balance sheet. Now there is the possibility to reprice every year. So what we, for instance, have highlighted at the IAIS is that one way or one important element to discuss is how protection gaps in terms of natural catastrophes could adversely impact the real economy. And then again, there is a role not only for insurers, I believe, but also for governments and ourselves as insurance supervisors to find a solution to what is a societal problem, I believe. So that's a short answer for something I think we could discuss during a few hours if you want to, but unfortunately we don't have time for that right now. If any of the other panelists would like to jump in, please do. Gustavo?
Hello. Just a few comments. I think we all, I mean the world, and the insurance community specifically, are in a position, a very dedicated, a very specific moment now that we might as well call it the perfect storm, because we are hopefully getting out of the pandemic with all its consequences in high interest rates, high inflation, and a possible recession coming, and the war, and the climate, and cyber, all this coming together at once. But the word that would describe this moment is, like Peter said, is uncertainties, right? All this amounts to a big uncertainty about what is coming next. But we are supposed to be the uncertainty specialists, right? So We just have to put our hats on and work hard to navigate the storm that is coming. We know that it's coming. From where, mostly, about which of these issues will hit harder, we don't know, but we have to be ready and work together, because we will only survive, let's say it, if we work together in a good manner in order to join efforts to go through the storm that is coming. Thank you.
Yeah, sorry, mic works again. Thanks, Gustavo. I think you picked up a few points I would like to highlight just at the very end of this panel. So, I mean, we've learned that we are in an environment of prolonged uncertainty, and uncertainty is very much also true for insurers. I think it was Peter who highlighted that the biggest mistake you can make is not to be prepared. So the lack of preparedness is something we should be wary about, and the role of CROs here is very important. I think they serve really as the function within the insurance company to make sure that insurers are prepared for the risks that are ahead of us. And as you said, Gustavo, both insurers and insurance supervisors are used to deal with uncertainty. So let that be our strength in a difficult environment. We've learned how, in terms of credit quality, it's time to start monitoring, because we've seen from the audience that credit risk following the global recession may be most of the important risk going ahead. We've seen the nuances in terms of impact of inflation on life and versus non-life insurance. The importance, as Sean highlighted, of being prepared, looking at how you word your coverages. And last but not least, and I think this is then something we take with us as supervisors, keep monitoring, keep it simple, don't overcomplexify it, take into account differences that are in the world. So we have seen, and you've explained it very well, Gustavo, how developing and emerging markets sometimes differ from other economies, and this is something, if you set up a global monitoring exercise, you need to take that into account. And I think with those wise lessons, I think I can try to close this panel. Thank you very much to all my panelists. I hope you found it a useful discussion. Thanks also for the virtual participants who unfortunately couldn't be here with us in Chile, but hopefully you'll be able to join next time physically. And thanks to the audience, it's time for lunch, I would say. Thank you very much.